Good morning, good afternoon, and good evening. Welcome to the second attempt at this webinar. We got Zoom bombed by some kids. So we are going to try again. We are having this seminar on whether central banks have learned anything from these crises, or whether they are learning anything from these crises. And this seminar comes out of a conference that Guillaume Vallet and I hosted in Talois, France, a year ago to this day. And I asked our guests to whether they would be willing to do a symposium in the review of political economy, and they've accepted. And so we have three guests today: Kristof Leahmann from the Central Bank of Hungary, Matheus Grasselli from McMaster University, and Richard Werner from De Montfort University in the UK. We have commentaries from myself, Mario Securities from the University of Ottawa, and hopefully, if he comes back, my colleague from the University of Laurentian University, Hassan Bougrin. So we're going to begin with a presentation by Kristof Leahmann. Hopefully he won't get bombed this time around, and he'll be able to finish his presentation. And we'll go to commentaries. Second paper by Matheus Grasselli, commentary. Third paper by Richard Werner, commentary. So without further ado, I'd like to call on Kristof to give his presentation.
Thank you very much, Louis-Philippe. I hope you can see my screen now.
We can.
Perfect. I also hope that this time we will not be hacked. Okay, thank you very much for having me here. And I remember the very interesting conference last year in Talois, when we basically tried to answer the question whether the central banks learned anything about the previous crisis, the 2008 global financial crisis. And since that, basically, now we already have another crisis due to the COVID-19, and we had a little chat, and I asked Louis-Philippe whether me and my colleagues can focus on this, because there are so many things happening and that are, I think, maybe not even linear, but very important for the future of central banking, and definitely the experience and learning curve of central banks, just due to the COVID-19. So the past 2.5–3 months were very important in central banking, I guess, and there are very important consequences that will be with us for a very long time, just because of the unique situation and the unique characteristics of this crisis and its economic impacts all over the world. Let me start with a few slides about the coronavirus crisis economic impact. First of all, which is, I guess, a very important chart, the initial claims in the United States of America. This is a very useful chart because maybe this is the most up-to-date or the fastest reaction in statistics to see what's going on in the labor market just due to the crisis. I choose the starting point of this graph from 2008, and it's very important that basically the previous crisis is just something like a very little change in the time series, especially if you compare that to the numbers that we experienced in the past few months. Adding up the numbers just from the initial claims, we can say that more than 38 million people lost their jobs in the United States of America, or actually registered for unemployment benefits. I guess, and I think this is very important because such a rapid drama and effect in the labor market maybe never happened in the history. And even though that the crisis situation was very sharp and very rapid, I guess that the solution for this unemployment rate problem will not be that fast, and it will be a huge challenge for economic policy, both for central banking and also for fiscal policy as well. The second chart is about the financial market aspect of the crisis. It's not only the advanced economies, but also the emerging market economies, countries were very strongly hit by the current crisis. Here, the most important message is that the COVID-19 crisis was much more dramatic in macrofinance terms than the 2008-9 global financial crisis was. Basically, the capital outflow from emerging economies were around 4 times larger than they were in 2008 and 9, which is, of course, a very difficult situation for central banks to deal with, especially with limited FX reserves that most of the emerging economies have, or actually almost all of them has a limited reserve, but most are facing difficulty with meeting the reserve requirements. Therefore, this effect only had a huge impact on the financial markets and the stability of those countries. This is a new situation because even some emerging central banks started QE type of programs, and I guess that's a very important consequence for all of us and for central banking in the future. The coronavirus crisis was very different compared to any sort of typical economic or financial crisis. And here it's not only the health effects and the health crisis that has to be somehow solved by governments, it's also how the economic consequences are moving forward. First of all, it's not only one sector where the situation, the crisis starts, but many sectors are immediately hit by the crisis. And most of the sectors had to stop their business activity or reduce it very, very significantly. The other very important consequence that it's not only the bad performing companies, the zombies that are facing bankruptcy situation, but also the best performing countries, the top ones, are facing very difficult situation if they are in one of the sectors that the crisis hit very strongly. These effects and these consequences or features are resulting in a very sharp and fast decline in economic activity. Maybe the recession will not be that long. However, it will be very difficult to deal with in the future. And definitely in a zero lower bound kind of or effective lower bound situation where many of the governments are highly indebted, the situation is very difficult for governments to deal with the crisis. I mentioned QE from the emerging markets point of view as well as a new tool. This graph is a very simple, I would say, classical type of understanding how the channels, the transmission channels of the quantitative easing or asset purchases are working. Here I would emphasize the portfolio rebalancing channel as a very important one, that has a very significant effect on the asset prices. And I believe quantitative easing is very important because of that channel, and that's something that will have very strong consequences on general economic policy and the society as well in the coming years, maybe the coming decade. And why I believe that is basically that asset prices were, I guess, mostly affected by the QE. It was not aggregate demand, it was not inflation, consumer price inflation, where the QE tools were very effective as policy tools from central banks. But asset prices were really affected by the huge amount of liquidity and electronic printed money in the past decade. And this is something that we currently can see in the stock market prices and indices as well. It's very important to mention this because if we take the examples of major central banks or even some emerging central banks, in case of the Fed, the quantitative easing and the increase in their balance sheet was so fast and so huge in just a little bit more than 2 months that this kind of extra liquidity effect that is taking place via the portfolio rebalancing and the asset price channel will be very important, I guess, maybe the most important for the future of these central banks. This is very important because one of the strong hypotheses that we have here in the Central Bank of Hungary is based on a little research or analysis from last year. We tried to look after or examine the most important factors that may have an impact on the balance sheet policy. And the question was whether it's a one-way street or not, whether central banks can decrease their balance sheet or not. And here, what we found could have been seen in the case of the Fed last September, when there was a huge tension in the repo market. And we found that one of the very important factors here is based on regulations, macroprudential regulations, and the liquidity coverage ratio that banks and financial institutions have to fulfill. And this is also true for Europe and the Eurozone banking system and banks as well. And it's very similar. Basically, there was a time in the past years, the past decade, which was the financial markets were full of liquidity, and the financial institutions had no strong liquidity issues after the 2012 period. And these regulations were starting to be effective just in a situation where liquidity was not an issue. Now, this graph is showing in the two panels the Eurozone countries' banking systems and their liquidity coverage ratios. And here the message is that without the TLTROs, basically many of the southern countries' banking systems would not be able to fulfill the LCR ratios, the 100 level of the LCR ratios. Therefore, it's not only the US and the United States financial system, also many of the Eurozone banking systems may have difficulties with meeting the LCR ratios with a lower balance sheet. So the answer to the question whether it's a one-way street, we believe that it's very likely that it might be a one-way street, or at least tapering cannot be very successful in a longer term, which means that these sort of liquidity situations and the increased balance sheets will be there with us in the longer term. And that's something very important if we combine this hypothesis or this conclusion with the asset price hypothesis as well. if QE has a very strong impact on asset prices and QE cannot be turned back, or the increased balance sheets cannot be turned back, then that's basically a very large change in monetary policy and in the future of monetary policy. And also it's a very strong consequence on all of the societies we are living in. Whether central banks have learned anything, I guess that not much. It might be the answer. And I have to say here that it's not only central banks, but it's general economic policy that is facing very strong challenges. From central banks, that challenge is, I guess, related to their mandates. And here, as many of the central banks are under inflation targeting regimes, their mandate or their primary mandate is related to inflation, or it's an inflation target. I guess that's something that might be challenged very strongly in the coming years or decade. It's even very important to mention that central banks in the past 10 years after the GFC stepped much closer to do policies that are very similar to fiscal policy, or they can mention to be quasi-fiscal policies like the QEs. And this is something that is even just accelerating due to the COVID-19 crisis. We, just before the GFC, already faced the secular stagnation. Advanced economies were growing in a lower pace. Also, the aging population might be mentioned here, which is something like a deflationary, a very long-term deflationary process in the activity. However, now we are also facing this just due to the very sharp recession and due to the labor market effects of this crisis. But there is a new emerging situation. It's not that new, but it may be also something that is accelerating, is geopolitics and the question of deglobalization or regionalization, sorry. Why I mention it, from the central bank's point of view, it's something that might be very inflationary, because the previous globalized system was very effective in turning down prices, especially with the previous 2 points, aging population and secular stagnation. However, this is something that we cannot foresee, and we do not know the effect of these separate factors. I mentioned here inequality as well. In this sense, I think that central banks will have to learn a lot, because many of their tools and their policies affected inequality very strongly in most of the societies. And this current crisis and its management is also strengthening the social inequalities. We may mention here, I would mostly focus on wealth inequalities here, because I guess that these huge amount of liquidity shocks with QEs will have a greater or more significant effect on the wealth situation of societies. So this is something that will definitely come up with very strong questions in politics, because I guess that inequality is not something that monetary policy can deal with. However, it causes problems, social problems regarding inequality. And these steps that are just increasing with the COVID-19 crisis, using more QE and printing more e-money, is definitely strengthening this problem. The question for me is the future of monetary policy, and what are the things that monetary policy can handle and solve under the current circumstances. Basically, in the past years, there was no inflation problem. However, central banks had to step up as stabilizers in the macro finances. And with these increased debt levels, I guess that will be a very important question in the future as well. Inflation is not something that I guess is really the matter currently in economic policy. But those what were just mentioned here, inequality, secular stagnation, the slowing down of the economies are not something that currently monetary policy can deal with, because it's not strong in the current situation with increasing or stimulating the aggregate demand. It would be a fiscal policy issue much more. However, it's very questionable how fiscal policy can be very effective in stimulating the economy in many countries. It might not be a question in monetary sovereigns. However, in Europe, definitely it's the top question how the economic policy mix may look like in the coming year. And for me, basically, just due to these factors, and this is something that we would like to focus on the paper, is how to reshape, or what might be the good possible new mandates for central banks to deal with these challenges, as most of them are not something that monetary policy can deal with. So new mandates may come up, but definitely some sort of new economic policy mix should come up, because monetary policy is not enough strong to deal with this situation, and the understanding of the combination of the two policies, how it is generally used, especially in Europe, is not something that might be effective to fight these challenges. Thank you very much.
Thank you very much, Kristof. Can you remove your slides?
Sure.
Thank you. Okay, so let me. Okay, thank you everyone, and I do want to apologize. I have kicked out a few people. I didn't recognize the names or whatever. I do apologize if you were legitimate viewers, but like I said, this will be recorded and we'll be posting it on YouTube. Thank you very much, Kristof. We'll go to commentaries, perhaps with starting with Marius Echereccia, and maybe some questions and comments. Mario?
Yes, thank you, Louis-Philippe, and thank you also, Kristof, for a very interesting, excellent presentation. I enjoyed it for a number of reasons. The first one is the fact that you are looking at, I mean, the very first thing when you started with those claims on unemployment, I mean, it's great that central banks are concerned about that, okay? I mean, I'm just being facetious here, but it's nice to see that. Secondly, more importantly, you did, in fact, highlight the way in which these financial flows are contributing to a lot of uncertainty, because also it affects the foreign exchange markets and all that, and that's something that I think one should highlight here, because it tells us basically, I mean, this is not unlike what was going on even in the 1930s to some extent, where you have these kind of uncertainties, where there's a kind of herd mentality going towards safe havens and all that. And the effects of that are devastating for countries that have huge debt loads in foreign currencies and all that. So this is where one needs, again, the sort of stuff that, you know, if you go back to the early post-war period, you know, agreements, not so much in whether we should agree on a fixed exchange rate, a sort of system as in the kind of Bretton Woods sort of scenario, but at least having to deal with this matter, okay, in a way that countries that are really facing hardship because of that are not going to collapse completely as a result of that. by means of some special agreements and funds available to be able to defend, in this case, those countries which are facing losses of that nature. So that's something extremely important. I'll just go on quickly here. And then we hammered. The other one has to do with QE itself. I mean, I appreciate your point that QE is primarily having to do with its effect, through the portfolio balancing issue. I mean, that I completely agree. In fact, I mean, if I look at what they're doing in this country right now with QE, they're literally acting on every, like if you look at the yield curve, they are buying up securities all along it. Okay, so they're intervening at each point along the yield curve, literally, which is very interesting. Not only have we seen prices decline, but they've been doing something which I remember Mark Lavoie and I wrote a paper some, God knows, 15 years ago, that came out in this book on central banking, where we were arguing that, in fact, central banks can do that. They could target all along the yield curve if they want. Okay? And they've been literally doing that, you could say, right now, which is interesting in itself. But at the end of the road, it's a bit of a, emperor has no clothes still, because even if you could impact on whether short or long-term interest rates, which they are, okay, at the end of the road, unless, the private sector in this case, unless there's some interest elasticity here, so to speak, of demand, it doesn't change anything, okay? We know very well, of course, that QE cannot directly, as in your diagram, you also had at the bottom that it could somehow directly lead to more loans. That I completely disagree. It doesn't. It's absurd almost, I would say. If you believe in endogenous money theory, there's no way that is of any value here. It's not going to happen. However, what it does, as I said, it's through these interest rate channels. And there it's important to highlight the fact that as much as it could do that, and I totally agree, the reality is that, it's like, yeah, you could do it, but it doesn't have any effect if we have so much uncertainty. Okay? In the current context, especially, are we going to see any changes in investment? Who in the world would want to, expand production? I don't know what, automobile or whatever, in a context where we can't really say much about the future right now. So I'm just saying this is rather important. And I will just try, I think I had a lot of things here, but I'm not going to do them all because I realize I don't think I have that much time. Louis-Philippe, you tell me because I will go on here. But I do have some other things I want to add here to this. Okay? And this has to do with the issue of inequality. In fact, it's interesting that you pointed out that central banks can impact on and could have effects on the issue of inequality, but not in terms of, I mean, now that they got interest rates down to the floor, basically, they can't do anything on the income side. The only effects are on the distribution of wealth, so to speak. And what has been happening there, needless to say, is that it is impacting in a way that is sustaining asset prices for those who own there, but it doesn't, so in a sense, I'm not sure that makes it more equal or more unequal. It seems to me much more unequal when it comes to wealth distribution, you could argue, because of the fact that those are the ones who are going to be favored by these kind of QE policies that central banks are able to enact. And the issue of inflation and deflationary effects going on, it is, well, it is true that there might be inflationary pressures. In fact, I was looking literally at the consumer price index in April in Canada, which actually for the first time since 2009, it declined. It went to negative by 0.2% inflation rate. However, if you look at the distribution, what we see is that the only prices that are going to be going, that were going up were, of course, those that, where we have imports, especially, like in the case of, fruit and vegetables and stuff that, in the grocery stores, there might be more limited and you might face higher prices, especially if there's a depreciation in the exchange, in our currency. But the point that I'm trying to make here is that most other prices of manufactured goods and so on, all of them were declining, in fact. Okay, and the biggest one, of course, is oil that we know internationally. I mean, that's the kind of the elephant in the room almost that did it. Okay, but the point is that when it comes to issues of deglobalization, especially that you emphasize, central banks really cannot do anything about that except as I said, through the foreign exchange markets or through investment flows and all that, or controls, on financial flows, but certainly not on commodity flows. And if indeed we do get into this kind of era of deglobalization, which I think will happen to some extent, but I won't hold my breath too much on that one. But for sure, if there's going to be any inflationary effects, central banks cannot do anything about that. What they can do, in a sense, if there's going to be a deflationary environment, what they can do is simply one thing, which is keep interest rates at the bottom and stay there, basically. Just peg them there, because you have to leave it to fiscal policy to do the work here. And that's the bottom line, I think. So this is why in this scenario, I would argue that central banks really, it's like the emperor without the clothes here yet. Yeah? They really cannot do much in that context than what they are doing right now, which is really impacting on, as I said, on asset prices. And there, as I said, it's not clear whether this is something that they should be, they should be concerned about it for sure, but there are inequities in the whole thing, in the way in which they act on that and who benefits from that in terms of wealth holders, which would, of course, be concerned about.
Mario, I'm just going to intervene. Thank you very much for your comment. I'm going to call on my colleague from the university, Hassan Bougrin, to say a few words. Hassan, if you want to turn your camera on. Thank you.
Yes, good to see you all. I was a little disturbed by what happened earlier, so I missed part of the discussion when it restarted. I'll be brief in my comments. The first one concerns perhaps the theme itself, or the title of the theme, have central banks learned anything? I would suggest the right question would perhaps be, have governments learned anything? Because I think that central banks do what governments want them to do. At least that's how we see it, if we are not talking about a totally independent central bank, which may be the case of the ECB. But other than that, I think central banks would work or go in the same towards the same objective defined and determined by policymakers, that's governments. My second issue has to do with this QE business. It is, well, okay, let me just mention, for instance, a study that was just put out, done recently, and it's coming out in a book that Louis-Philippe and myself edited in honor of our colleague and Professor Mario Seccareccia and Marc Lavoie. The study was done by Jerry Epstein and one of his colleagues on QE in the US during the 2008-9 Great Recession. And it clearly demonstrates that indeed QE benefited mainly the big corporations. Okay, so that shows the expected effects of any QE we might be looking at now or in the future. in terms of inequality and the effects it may have, etc. For that reason, again, I go back to my first point, governments need to orientate whatever money or liquidity would be injected by central banks into the economy towards sectors, industries, and even people who would actually benefit from that new liquidity and sort of tilt the inequality more towards the disadvantaged or those who need more support. And my third and last comment has to do with this, the issue of capital flight. Kristof, you showed like there is like so much capital flowing out of the emerging economies. Where are these going? Where are these capital flows? Where are they going to? Supposedly they are moving somewhere. Where do they go? And
advanced economies, I guess. Yeah.
Pardon?
I guess advanced economies like the US or those who are safe haven, I guess.
Okay, so, but then the issue here is how, again, to deal with the negative effects of these capital flows. Central banks, can they do something about that? Again, I go back to the role of governments. It is the old issue of the trilemma, the impossible trilemma. Can we do like handle all the three issues, the interest rate setting, the exchange rate setting, and capital flows? Well, yeah, of course. So, but then we need some capital control, okay? And that is, again, something that can be implemented only if we have the will of the government, okay? And because as we know, and we have heard from Mario talking earlier about the vested interests of central banks, and I'm not going to get into that. So I think I leave it at that so I don't take more time than necessary.
Thank you, Hassan. Kristof, if anyone else has brief comments, you can maybe unmute yourself and make that brief comment. I guess no one else. So I'll pass the word back to Kristof to give a couple of answers if he wants.
Thank you very much, Louis-Philippe. Well, basically just one remark here. I would like to thank all for all the comments, very useful ones. Mario was very sharp and he saw the mainstream flow in my presentation with the with the transmission mechanism of the QE. Actually, I just would like to say it's a very fair point and very important fact that he mentioned here. Also, the other points were very important, but I just want to say that I am not here against endogenous money, not at all. Just wanted to emphasize only the portfolio channel of that due to the asset prices, but definitely I do not believe that QEs were very effective in bank lending in the past decades. So this was just reserved for central banks, and basically the private entities, the commercial banks were there or should have been there to lend, and that was not due to the QE and the electronic money printing at all. Very good comments regarding inequality, wealth, deflationary issues, the government. From Hassim, I just would like to thank you all for the comments.
Thank you very much. We're going to go to our second speaker now, which is Matheus Grasselli from McMaster University. You can share your files now, Matheus, if you have any.
Okay, thank you, Louis-Philippe. I'll start sharing soon. I just want to speak a little bit before files. So yeah, thank you very much for the invitation and also for the graceful handling of the Zoom bombing that we just had that added to the excitement. So it's a little bit of a running joke about COVID when you read commentariat and watch talks that most people say that COVID has just demonstrated X, and X is exactly what they believed all along, what they thought was right all along. So I'm going to start by doing the reverse. I'm going to start with something that COVID surprised me. In 2018, there was a meeting organized at the OECD by the New Approaches to Economic Challenges group, commemorating the 10th anniversary of the 2008 crisis. And one common, so the many aspects of the crisis, but when it came to central banking, one common concern, and this was expressed by Jean-Claude Trichet and by people like Bill White from formerly at the BIS, was that when the next crisis came, that central banks would be more constrained because regulation, say the Dodd-Frank Act and other similar developments in Europe and the UK might constrain the amount of lending or the type of lending that central bank can do in the next crisis, and that asset purchases were deemed to be too high, so there would be more containing asset purchases, and that crucially swap lines between central banks of different jurisdictions might not be done at all because of lack of trust and lack of coordination, because of the political climate that was now in place. Well, I think COVID has shown that to be all wrong. When the crisis came, central banks acted very similar to what they had done in 2008, and more in a much higher scale. So I'm going to start sharing. The first graph is the graph to rule them all, so to speak. If you can see it, can you confirm that you can see it? Yeah, so this is the total size of the Federal Reserve balance sheet. And I'm going to concentrate mostly on the Fed. I think Kristof talked about Europe, and I'm suspecting that Richard is going to talk about the Bank of England. So I'm going to focus most of my remarks in the Fed. So what you see there, again, it's similar to the unemployment graph that was shown before, that the expansion in the balance sheet of the Fed that happened in March this year dwarfs what had been done in the previous crisis. Not in relative terms, this was a doubling of the balance sheet. Here it just went from 4 trillion to 7 trillion, but in absolute terms, it's very high. And a lot of what I want to do is to unravel what is behind that expansion of the balance sheet and what all the mechanisms were. So why did the Fed do that? Well, the Fed sprung to action faster than the actual government of the United States, which was still debating how to do a decent fiscal package that would pass both houses of Congress. But the Fed thought that they had to start acting. Well, one reason was what was happening on stock markets. And again, you can see here the rapidity and the scale of what was going on. There was a drop here in the S&P 500. It's about an 18% drop from January to March. So quite fast. You know, it took a lot of time during the last crisis to have a similar drop. The drop was deeper there, but it was over a longer time. And in particular, everybody knows, I was just checking Wikipedia to see what names were given to this, but you know, there was the Black Monday and then the second Black Monday, and they run out of names to give to the drops that were happening around March. But there was the largest one-day increase. You know, there were circuit breakers that were supposed to stop at 7% losses, but the losses were so fast that they went beyond the circuit breakers. By the time the circuit breakers acted, they were already at 9.7% loss. So it was really, you know, scary stuff that was going on. But what you can't see in this graph, because it just shows the absolute level of the S&P 500, is the volatility. So in the next graph you have, now it starts to look very much as what was in the 2008-2009 crisis. So this is the VIX index and the measure of volatility, and we're seeing here levels of volatility in March that had not been seen since the last crisis. Then what did the Fed do? So I'm going to separate the actions from the more conventional to the more sort of unconventional and aggressive. So the first line of defense for any central bank is the conventional monetary policy, which is to look at interest rates. So this is what they did. So again, I'm following the theme of stretching graphs back to 2008. So this was the decrease in interest rate. It took almost a year and a half to go down from 4% to close to zero. Here, the 1.5% drop occurred in 2 weeks. There was a 0.5% drop in one announcement, and then a 1% drop in another announcement the week after. So again, very rapid and on a scale much larger than what we had seen before. So this was, you know, with the conventional monetary policy, as I said, but the next step of what central banks do, in particular in types of crisis, is to assume the role of what's called lender of last resort. So this is, again, a comparison between what happened in 2008 and what happened right now, but only on what I would call emergency lending facilities. So this includes what traditionally had been called the discount window. Now it's separated into different types of credit, primary, secondary, seasonal credit, but it plays the role of the discount window. And then several other facilities that are available to primary dealers and institutions that are the closest to what the Fed is doing. So this is emergency lending primarily in the domestic market for large financial institutions. And again, you know, this might continue to rise, but you can see a steep rise comparable to what was going on in 2008. The other part that enters the expansion of balance sheet then is the swap lines that I mentioned before. So this is swap lines between different central banks, and in 2008 they were extended to these banks, so the Bank of Canada, Bank of England, Bank of Japan, the ECB, and the Swiss National Bank. So a select group of central banks that had access to the swap lines, and boy did they use it. They used up to you know, $600 billion at the time, and this is because of the amount of dollar-denominated financial transactions that go around the world. So whenever there's the crisis and there's a credit squeeze and they have to pay liabilities or you know, liquidate liabilities, if they are in dollar, they need to have access to dollars. And this is how the central bank then becomes the United States Central Bank becomes the lender of last resort for other countries as well. So in here, in what has just happened is that those swap lines were then extended to 14 countries, including Mexico, Brazil, and South Korea. And they had both total limits and relative limits for the countries, and they were immediately exhausted. So I was following that, what was going on more or less in real time, and you can get the data from the Fed, but the maximum that was permitted was 450 billion, and you can see here 450 billion almost spiking up instantaneously. And of the 14 countries, only 4 didn't do, and they didn't do to the point that they didn't borrow a single penny. They didn't use the swap line for a single cent, I should say. Which makes me suspect that it's not because they didn't need, it's because they were too late. Because, you know, if they needed little, they would have borrowed little. They were too late and they reached the limit and they couldn't do that. And that includes the Bank of Canada and the Central Bank of Brazil, by the way. The next step then in the sort of arsenal of the Fed is going beyond lender of last resort, and this is something that is started in 2008 and I think is coming back with full force now, is what Perry Merlin calls a dealer of last resort. And this has to do with the fact that modern banking systems and the modern financial arrangements do not follow the traditional view of a bank that it's then providing loans and taking deposits. So it's an intermediation between surplus agents and deficit agents, primarily in most economic models, households that are lending to firms. And then there's all sorts of endogenous money that goes in there. That was a valid picture for banking pre-money market funds and securitization expansions that happened from the 1970s onward. So what goes under the name of shadow banking sometimes, but it's broader than shadow banking, is the overall securitization of finance. And again, to quote Harry Merlin, he says, instead of deposits funding loans, it's money market funds, money market funding of security markets lending. So you have very highly securitized portions of the financial systems on both sides, on the borrowing and the lending, and banks, traditional banks, sit in the middle and kind of straddle this and make a lot of money by acting as dealers and not only lenders. And the problem is that for markets like that to operate, there needs to be some sort of, you know, you can look at models for market making and so on. Dealers make money on the spread and they take risk on their inventory, but the model breaks down if there is no outside spread, so to speak, an ultimate buyer and an ultimate seller. And during financial crisis, that's what tends to disappear, this kind of outside bounds, and the central bank provides that, so they become the dealer of last resort. So a lot of that started in 2008 very dramatically around September and so on. So these were all the sorts of facilities that were never there in the repertoire of central banks. So the graphs there show what's called the asset-backed commercial paper lending facility and the commercial paper funding facility. Yeah, asset-backed. So they're both related to the idea of intervening in securities markets directly so that the markets function and removing a lot of the uncertainty that was mentioned before. So I don't have, they're not showing the data separately yet. I tried to find and I couldn't find. And one of the reasons why this was not only, this is only what the Fed provides, but a lot of these facilities were organized as a special purpose vehicles. So entities that are legally separate from the Fed, but they are backed by the Fed. And the only thing that they do is to buy this type of paper and have a separate balance sheet. So these were all off balance sheet transactions, don't even show in that graph that I showed at the beginning. And there's a lot of that going on right now. And what I say here is that some facilities came back, like the commercial paper funding facility. The money market funding liquid facility has morphed into this new one. And this new one now is being extended to include a state and municipal debt as well, which was also something that was not purchased in 2008. And more dramatically, so for people in the know, they call March 23rd the whatever it takes moment for the Fed. So everybody knows that Mario Draghi put a stop in the severe problems in the Eurozone when he said that this ECB was going to do whatever it takes to sustain the Euro. And then he didn't have to actually do it. It's that thing that, if you, the myth that if you have a bazooka, you don't have to use the bazooka. In the Euro case, it kind of worked. In the United States, on March 23rd, Jeremy Powell did his whatever it takes. He said, yes, they were going to be buying unlimited amounts of assets. And just to prove that he was serious, they started buying corporate bonds. And corporate bonds are something that, no other central bank in history has dared to touch because it's fraught with accusations of favoritism and so on and so forth. Not this time. So they're going full force in that. So if I just go back to the first graph, and I'm not going to go too much longer, this is breaking up the blue line is the line that I showed you before, but just to show you what are the main categories of them. So of course, purchasing of government securities themselves, it's a large part of it, and it's but both to as part of open market operations to deal with the interest rate, but certainly not that afterwards, because the interest rate was so low already. So this was providing sort of dealer support to the markets in US securities as well. And this was very much prominent here because these markets were suffering stresses, because there are all sorts of perverse things going on in the highly stressful and uncertain moments of the crisis. So for example, if you're managing a fund and your clients want to remove money from the fund. So you try to liquidate assets. So you don't liquidate the ones that are in free fall. You try to liquidate the ones that have a deep liquidity. So you go and liquidate the safe ones to turn into cash and give the cash to your clients. Well, that propagates then the pressure from the equity markets to the bond markets as well, and the Fed thought that they had to intervene in there. There's a little purple line running in the middle, and it has a bump in here. This is the increase in repo facilities, and it had to do with the liquidity coverage ratios that Kristof mentioned before, but it's not playing too much of a role here. And the little blue line is the swap lines that I was talking about, which look big in the other graph that I showed, 600 billion in here, 450 billion in here, but of course in the scale of the entire balance sheet is not that big. And I just wanted, so I put there the dates for the previous QEs, and one thing I want to emphasize is that, QE1 was not what provided the first expansion. The first expansion happened before QE1, and it was all about the two roles that I mentioned before, lender of last resort and dealer of last resort. And here you can see very clearly the inflection points on the asset purchases when the other QEs started. And the scale of what's going on here is also what is extraordinary. They've been buying to the end of March, beginning of April, they were buying both mortgage-backed securities and government bonds at the rate of $85 billion per day. So that was the same rate as what was done in QE3 per month. So it's a daily purchase that was equal to the average monthly purchase in previous QEs. So completely new territory for what might happen with this scale of asset purchases. And the last slide that I want to show is it's the flip side. So this is the assets of the Fed. On the flip side, there are the liabilities. So how have the liabilities reacted? Well, there's a steady growth of currency in circulation, cash. There's, of course, huge increases in deposits of the banks that have accounts with the Fed. And this was the period of the other QEs, QE, and this is what's going on now, this huge increase. But significantly and differently this time, also at a scale larger than in the previous crisis, is the treasury balance at the Fed. So this is something that, like MMT has been emphasizing, that the Fed, the Treasury coordinates with the Fed in their spending, and the two support each other in their policies. And there is an account that the Treasury can spend with the Fed directly, and that's the treasury balance. This is going on here very dramatically, and I think the Bank of England made a similar statement around this time that they would increase the limits of the government, the British Treasury would have to spend from the balance at the Bank of England. So my provocative question there at the title, and this is the last thing that I'm going to say. So I said, I was going to start with something that COVID proved me wrong. Now I'm going to suggest that COVID proved me right. In the lead up to that conference in Taloa, I had written 2 papers related to central banking with my co-author Alex Lipton. In one of them, we explored the issue of negative interest rates and what if negative interest rates were allowed to go unboundedly negative, so not to have a zero lower bound or even an effective lower bound of minus 0.25% or 0.5%, which is the result of the fact that there's a physical lower bound because it makes it's too difficult to withdraw large amounts of physical currency. So what if that was removed? And we showed in the paper in a model that it would have macroeconomic consequences that would stabilize, but it would have to be really negative, -2%, -3%. And the only way to do that is if there is no alternative, there's no there cannot be large withdrawals of cash. And so that's the issue of central bank digital currencies. And in another paper, now, you know, because of this immense purchase of assets and the role that the Fed is playing in backstop in all types of credit to all sectors of the economy, including corporations, it looks like it's only one step away from something that we mentioned in the paper. The paper is overtly about narrow banking and how you can do narrow banking, so 100% reserves, so that banks become facilities for the payment system, and you leave the lending to what we call lending facilities, which are then fully equity-based, which look exactly like the securitized lending that I mentioned before, money markets on one side and lending on the other side. But those entities don't have to have any support from the Fed. They are just like any other corporation, and they can be let go with no problem, because then you separate the payment system, which is what the Fed tries to protect, from the lending, which you know, historically has been done by the same institution, but there is no actual sort of both either economic or physical reason that it has to be done as well. And again, central bank digital currencies would help a lot in there, because they would provide even a direct access of small enterprises to lending by the central bank. And this was something, and I will stop here, something that the US government learned the hard way, because as part of the CARES Act, there was a provision for lending to business, and they, with a lot of intention to lend to small businesses, but they decided to do that through the banking system. And what they discovered is that the banking system was not interested in lending, for the reasons that Mario mentioned before, but also for the reasons that they would just occupy space in their balance sheet, which is being profitably used to act as dealers and not as lenders. So if you want to lend directly to small enterprises, then go ahead and do it. And if you don't want to do it through the fiscal part of the government, then do it through the central bank. So that's all I had to say. Thank you.
Thank you, Matheus. Thank you very much for the very wonderful presentation. We're going to get some questions and comments. Mario, if you have anything to say, maybe take no more than 5 minutes. You're unmuted now. One moment, Mario. There you go. Can you unmute yourself, Mario?
Okay.
There you go.
Oh, okay, fine. We're playing tic-tac-toe there or whatever. I really I appreciated what Matheus did there. I mean, he's covered a lot of really interesting ground, and a lot of that I completely agree with. I mean, I couldn't agree with it more. The only thing that's sort of, I'll stick to that. I mean, there's a few other little things, but I'll stick to this one right now, because I think if you give me 5 minutes, that's it. I was concerned about this this idea that you want to go to narrow banking, then investment banking, as it's like the, what do you want to call, the New Deal of the, you know, the vision there, if you want to call it, but in a much narrower sense, because now the problem here is that how will it happen in this system if indeed, and I mean, I have no problem with having certain types of institutions. I don't know if you could call them banks, by the way, okay, but institutions that hold deposits, okay, and that have 100% reserve requirement and deal in these money markets or whatever to make their gain. But the problem that I have is with the other one. What kind of banks are we talking about here, really? If it is in the form of kind of shadow banking, are they creators of money is the issue. Okay? And that's one of those open questions. Okay? I'm not sure if I have a simple answer there, but for sure it's a debatable issue, and it remains, I think, unless you could correct me there. And the reason why I'm saying that, because once you do that, then you completely get rid of the elasticity, if you wanted, the monetary system itself from functioning, okay, for the purposes of financing spending out there, okay, private spending in this case. So that's where it becomes a trap here. That's the way I see it personally. And therefore, I'm not sure I would agree with you there. But I completely agree with you, especially I'm all for the idea of central bank digital currency. I think it's great as long, you know, and it could do exactly what you're saying. That's one of the things it could do is enforce these negative interest rates. You could do whatever, okay? It gives a lot more control, the way I see it, for central banks. If people want more control at that level, so is the issue.
Thank you, Mario. I remember when Matheus, maybe a year ago, brought up this issue of this paper he was going to write on shadow banking and
Narrow
narrow banking. Yeah. Yeah. And if you remember my reaction at the time, you know, okay. Thank you, Mario. And on digital currency, I know that Richard will have maybe something to say about it. Does anyone else have any comments? Anyone else have any comments? So I'm taking that as no. I'm asking then for Matheus to answer Mario's question, comments.
Yeah, so I think, so first of all, the idea of narrow banking, I admit is provocative, but it's there to throw something at, you know, what we are seeing. We are seeing banks not participating in the lending role that they traditionally were assigned to. And then the Federal Reserve comes in and supports the dealer activity, which is all securitized. So if that's what in practice is already going on, then do that by regulation and by changing the charter of this bank. So on what you said, it's a clear separation of the payment system, which is what we would like to call money, and you know, this is the part of the endogenous money, is that the banks can increase the deposit base. But why are they increasing the deposit base? Is because they are provided lending. So at the same time, they increase their assets and their liabilities, and that provides more money. But if they were to not have the lending role, and the lending is separate, it's a separate institution, it's a lending facility that has to fund itself with equity. Then the equity of that institution is most definitely not money. So they are not going to be creators of money. And then, but then how do you provide elasticity for monetary reasons? Well, what do you need elasticity for? So if you need elasticity to prevent bank failure, well, this is not going to happen in this case, because this banks will have 100% reserves, so they only have operational risk. There's not going to be a run on those banks, so you don't need the elasticity for that. Now, what else do you need elasticity for? Well, if elasticity is to provide lending and income support to households and firms, which is a, you know, very novel role of central bank. That's not the traditional role of the central bank. Well, then you do that through the accounts with the central bank that the central bank digital currency offers. So it's an entire package, right? But that's how I would suggest.
Thank you, Matheus. I'm not sure if Mario agrees.
No, well, I don't know if we have to, I'll let it go. I don't completely agree. I mean, I understand some of his points.
Okay, well, thank you very much. We are now ready for Richard Werner's presentation. Richard, I would like to invite you at this time to unmute yourself and to share your video slides, if you have any slides. Unmute yourself. I'll do it. Perfect. Thank you very much.
Great. Okay. All right. there's two things I'd like to talk about. One is simply the discussion of the current situation, analysis, and how I see the situation, and also the risks and dangers and necessary policy responses and assessment of the current responses. But before then, and also to put that into better context, I think it's important to more or less present you with some key planks of my analysis before these things happened, February, March, and government, lockdowns were imposed and so on, and this crisis started. Because then I think you will understand better why I'm saying what I'm saying about the current crisis. And you'll see that my analysis before the crisis, I think, is actually quite eerily relevant to analysis of the crisis. Let's start with the solution to some of the puzzles in macroeconomics. Details, of course, in my book, New Paradigm in Macroeconomics. As you all know, the monetarist paradigm collapsed in the 80s when the velocity declined. Even now, people analyzing this current central bank money injection, you see a lot of comments about, oh, velocity decline and velocity, all that. But this problem was essentially, this puzzle of velocity decline was not really solved at the time. It triggered the many of the economists to leave any monetary analysis behind. So the mainstream at that time decided, oh, this is kind of too difficult, this monetary stuff. We're going to have models without money and certainly without banks. And so then we embarked on that neoclassical venture that you're all quite familiar with. But there is a solution, and I think it's one that is, I think the minds of post-Keynesian economists are very open to. I published this in 1992 first. The solution is very simple, that if you go back to the quantity equation, mv equals py, and velocity, of course, is the residual there. Velocity is simply nominal GDP divided by M money supply aggregate, and then you choose which one, M1, 2, 3, 4, 5, you name it. But whichever one, velocity declined in the 80s. Now, of course, since then, velocity has declined much, much more, and the little drop in the 80s now seems modest, and you think, well, why were they worrying about this? So velocity has completely collapsed since then, and again, with the recent data, this is accelerated even further to unprecedented levels. But what was the story really? What's happening there? Well, it's very simple. This quantity equation, mv equals py, is simply wrong. It's never been right. It's wrong, or it's a special case that rarely applies, because you're assuming here the m on the one side, the money supply, however you measure it, and times velocity, sort of the effective money supply, is used only for the real economy, P times Y, nominal GDP, right? But since the early 80s, in many countries, money has been used to a great extent for asset purchases and has circulated in asset markets. And of course, that's something that I think every speaker so far has mentioned from one angle or another. Therefore, we need to disaggregate the quantity equation to make it correct, and split money into that money that's used for P times Y, nominal GDP, the real economy, the tangible economy, and that money that's used for asset transactions, the financial circulation. Now, this could potentially be difficult to do if we stick to the traditional way of measuring money, M1, M2, M3. But these traditional ways of measuring money are not actually very useful because they're also wrong as well, because all these M measures from M1 to M25 around London, if you're familiar with the UK road network, all these M's are measures of private sector assets, And as Milton Friedman, the arch monetarist, already admitted, we have a problem with those because we don't know where's the line to cut off. You know, why M1? Why not M2? Why not M3? Why not M15, where we include real estate and anything you want? And that's always been the analytical problem. Because essentially that's not money. It is not money. So the M's that have been used in this traditional analysis are not actually the money supply. What are they? Well, they're subsets of the savings supply. Private sector savings, one way or another, and that's money out of circulation. But originally the quantity equation started out as a transaction equation. If you go back to the old Fisher version, it originally was actually about transactions, and therefore that's, you know, we can't measure, you know, we can't look at savings measures to get an idea about money that's used for transactions. So really what we'd like to do is measure money used for transactions. And we can do that if we understand the money creation process. And I think this is a great audience for this topic, because I don't have to explain much, because you're all familiar with how the money supply is created. It's created by banks when they extend loans or purchase other assets, because loans are also asset purchases. And that creates the money supply. In other words, it is credit creation. So let's ditch the M and let's call it C. And then we can actually do what is necessary, split the quantity equation into its two streams. The real economy, credit used for the real economy, and credit used for financial transactions. And this is perhaps where I could briefly show a presentation. It's not a full-blown presentation. I'm just going to show you snippets. I just wonder, oh, there it is. Can you see this? Can you see this?
No, we cannot.
Hang on. Oh, I think it's my computer. It's now, I've got a black screen now. Maybe in a little while you see something.
It's loading.
Something coming up.
It says you have started screen sharing. Ah,
Okay.
there you go. Thank you.
All right. So this is the traditional quantity theory of money has been disproven by the quantity theory of disaggregated credit, or short quantity theory of credit, which I published, well, also a little while ago in the 90s. And so essentially you split, first of all, money is credit creation, and you split that into these two streams, the real economy and the financial transactions. And then the traditional quantity equation becomes a special case that applies for only that credit creation used for GDP transactions. So when banks create credit for business investment in particular, that generates non-inflationary growth. Or if it's for consumption, then of course you get inflationary expansion of nominal GDP. But when credit creation takes place for asset purchases, then that's a separate circulation. It drives up asset prices, and it certainly is the key explanatory factor in asset markets. But it doesn't really directly affect the real economy. There's a little bit of spillover, but it's actually remarkably stable. And you can do all the various tests. We won't have time to go into this, but with this, I demonstrated that velocity, the real velocity in the second equation here, VR, actually was stable even during these boom periods, because the velocity decline that people observed was simply the old equation, mv equals py, not being true, money supply rising, but not going into GDP. And then you get the illusion of a velocity decline, because you're assuming money goes into GDP, but it doesn't, it goes into asset markets. So the key insight here is that we need to define the money supply correctly. It's credit creation created by banks. And we also need to split into two flows. And it's these two separate markets, the real economy and the asset markets. They can act very, very separately. Now that's a sort of important background. With this, if we analyze what happened in the 2008 crisis, then really it's very similar to all the banking crises. In what happens in all the banking crises is that, in fact, maybe I can take this down, but maybe my computer, is this a, can you see the presentation still?
Yes.
Okay, maybe now.
Perfect
Okay,
size.
good. Yeah, I'll just have maybe one or two more charts. Sorry, it's slightly cumbersome on my computer. So what happened in 2008? The same thing that happened in Japan in the early 90s, the same thing that happened in the early 1930s in the US. It's always the same story. Bank credit creation in the previous decade, so in the US in the 1920s or in Japan in the 1980s, expanded dramatically for asset purchases. You get this asset boom. In the real economy, you may have no inflation or in fact deflation as Japan in the 80s observed because bank credit was mainly for asset purchases. And of course, this happens under the watch of the central banks, usually encouraged by the central banks, like in Japan. I demonstrated this in detail in my book, Princes of the Yen. But whenever banks create credit for asset purchases, this is unsustainable and will lead to problems if it's big enough. And usually, well, in these cases, it is big enough. It will lead to a banking crisis. Why? Because you're pushing up asset prices. And essentially, because this is fueled by bank credit, you need sustainable income flows to service and repay those loans. But if it's used for asset purchases, the money in bank credit is given for asset purchases, you don't have those stable income flows because you only have capital gains, and they're dependent and contingent on the banks continuing this expansion and credit creation for asset purchases. So it's a Ponzi scheme, and it works as long as the music plays, as long as banks continue to expand credit for asset purchases. The moment they stop, then the whole thing collapses. And so, of course, this happened in Japan in the early 90s, happened in the US from 1929 onwards, and again in 2008, sudden stop. You know, there's various triggers that are possible, but the result, you know, if the result is that bank credit creation for asset transactions stops, the house of cards comes down, and then banks go bust because they don't have enough equity, because you've got non-performing loans, and non-performing loans in those cases will be substantial, between 20 and more percent of bank balance sheets, but they only have less than 10% of equity. And then what do you do then? Well, then you have a decision to make as a policymaker. You can either do what the Bank of Japan did in the 1990s and say, well, that's fine, we don't mind. We'll let market forces take over. Banks will continue to restrict credit because of the non-performing assets. The real economy goes into recession. Everything shrinks. The banking situation gets worse, and you can have a 20-year recession. And that's what the Bank of Japan engineered. But you can do also what the Bank of Japan did when there was an even bigger banking crisis in 1945, when all Japanese bank assets were non-performing 100%, when Japan lost the war. And then the Bank of Japan decided, no, we don't want a banking crisis and recession out of this. That's not a good time. So the central bank purchased the non-performing assets of the banks at face value. They shifted to the central bank, and the problem is solved. There's not even a recession, maybe 1 year, but that's it. Now that was my proposal in Japan, and I called it QE, an expansion in the quantity of credit creation. I was in Tokyo at the time, published in the Nikkei in 1995. And in these debates we had, or various foreign voices were also heard. One was Bernanke. And so then fast forward to 2008. When 2008 happened, it seems Bernanke was very much looking at the debates in Japan and the situation in Japan, and he genuinely didn't want to repeat what happened in Japan. And he seemed to remember my advice that the central bank needs to purchase the non-performing assets of banks. Because the Federal Reserve, and this is where in previous discussions I missed slightly the differentiation, because central banks reacted differently. The Fed was more or less the only central bank that had a fairly effective response to the 2008 crisis. Other central banks seem to be doing the same thing, but the result wasn't very good. And that's because they did not do the same thing. The big difference was the Fed purchased non-performing assets of the banks, lock, stock, and barrel. And that way their balance sheet was rapidly improving, and already 1.5 years later, bank credit was expanding again. And you need that for an economic recovery because it's the bank credit creation that makes up the money supply, as we all know, and then you get economic growth. So the Fed did a reasonably good job there. And of course, not ideal. I would have done a lot of things differently. As we know, a lot of money went into the pockets of the very well-connected hedge fund managers and wives of bank CEOs and Fed-related people, all the usual stuff when you're talking about billions and billions. This time around, you're talking about trillions. Anyway, so that's the story. Other central banks didn't do this. They did what the Bank of Japan, they copied the Bank of Japan. You see, because Bernanke was aware the Bank of Japan did it the wrong way. He even said in 2009, a lecture at the LSE in January, we're not doing Japanese style QE. We're doing something I don't even want to call QE, and I call it credit easing. Well, that's actually closer to my original definition of QE when I proposed it, because the definition was, as published in the Nikkei, an expansion in the quantity of credit creation used for GDP transactions. And he was certainly much closer to that than other central bankers. So other central bankers just did the usual asset purchases, treasury purchases, and liquidity was expanded, but going really not into the real economy, into asset markets. Because that also happened in the US, but in the US, at least at the same time, we had bank credit expanding, growing by 4 or 5% already from 2011 onwards, 2010 onwards. And therefore the economy recovered much faster and much more significantly in America than anywhere else. Eurozone disaster for many years and so on. And Japan, of course, famously. So before I now come to a comparison to the current situation, there is another important story that, in fact, the story that has been mentioned by the previous speakers. The Bank of Japan was a forerunner in many ways of what's been happening. And that also includes the, throughout the 90s, the Bank of Japan gave the impression, wanted to give the impression that it's helping the economy. And it did a lot of measures to give that impression, but actually it was not helping the economy because it let the banks just restrict credit, and it didn't step in, it didn't buy the non-performing assets, it didn't take the steps that would have cost the taxpayer nothing to get out of it, as it did in 1945. Instead, we had 20 years of recession with record unemployment and huge cost to the taxpayer with debt GDP ratios now close to 300%, all completely avoidable. That was the Bank of Japan. But to pull this through, if you're interested in the reasons, we can maybe discuss later, but it had reasons from its own perspective. It thought these are good reasons, but it didn't want to disclose those reasons, and it instead needed to give the impression that it's doing everything to help the economy. And it was helped by neoclassical mainstream economics, because mainstream economics has essentially, it's like a propaganda veil, because it gives you very misleading stories about how the economy works. And the Bank of Japan used this very cleverly. It said, look, interest rates, according to the mainstream stories, is the main policy tool. And so, yes, we study this. We invite famous professors from the US, and yes, they all tell us interest rates is the main policy tool. Okay. Oh, we need to lower rates. Okay, we'll lower rates. And then we lower rates again next year. And then we lower them again next year, and we lower them again. And so in the 90s, they lowered them a dozen times. In fact, well, when I published my QE proposal in 95, I warned them, you won't get a recovery by lowering interest rates. You can lower it to zero. We're around 5% then. That's not going to help. They then wanted to prove me right by lowering to zero, and it didn't help. But it helped them in their presentation to the public. Oh, we're taking dramatic steps. Look, this is all the things we're doing to help the economy. I also want that fiscal policy is not going to help if you do it in the traditional way, because there's no debt monetization. And to the extent that the bonds are purchased by non-bank investors, you're just crowding out the private sector. We probably won't have time to go into that. I'll stick to the interest rate story. And so the central bank seemed to be helping the economy by lowering rates to zero. And this is still the scenario that was copied from 2009 by many central banks, even the ones that then said, like in the Eurozone, more or less informally, yes, we're doing QE. But why are we doing QE? We're purchasing these government bonds because we're pushing down yields, because lower interest rates are good. And an earlier speaker was talking about how I think it was Mario, you can, you know, the whole yield curve, central banks can push down the whole yield curve. They can target any aspect of the yield curve. I entirely agree. And that has happened. So the yield curve has been flattened by central banks, has been pushed down, even negative, downward sloping yield curve. And the official story is this is great. This helps the economy because money is cheaper. Now, I did the first, so actually, this is something that all equilibrium economists share. This is like a common belief that if you lower interest rates, you stimulate the economy. This is true for all economists in the last 200 years, from mainstream to alternative economists. Certainly, if they use some kind of equilibrium or semi-equilibrium framework, they argue this. But there's never been empirical test of this hypothesis because it's entirely derived from theory. I published the first empirical tests. This is actually in 2018. You can look it up in Ecological Economics, Reconsidering Monetary Policy. It's open access. And the empirical test result is actually this one thing where all economists agree on, that if you lower rates, you get higher growth. There's no empirical evidence for this because interest rates are not this monetary policy tool. The empirical evidence is that interest rates follow growth. And in terms of statistical causation, the causation is not from interest rates to economic growth, but from growth to interest rates. So interest rates are a residual, they're positively correlated, and therefore, of course, pushing down the yield curve and having a flat or negative yield curve is not going to stimulate the economy. In fact, it will do the opposite. Why? Because you're squeezing out banks. Now, somebody mentioned, well, if banks are not lending, we better abolish them. Why aren't banks lending? Why haven't they been lending in the Eurozone for the last, well, 12 years or more? Why haven't they been lending in Japan for 20 years plus? Because the central bank has been killing banks. Under the ECB, already 4,000 banks have disappeared in the Eurozone. In America, more than that, I think it's over 5,000 banks have disappeared in the same time period. And also the Bank of Japan has overseen the annihilation of banks. Why? What's happening? Well, they're squeezing their margins. By having a flat yield curve, you're killing the banks. They need a positive yield curve to earn some money. And of course, it also means they can't lend, and they're not interested in lending. The only thing they can now do is take asset collateral, because that's what central banks encourage to do by the asset reflation through the wrong type of QE by purchasing assets. So that's what banks are also doing. So really, this is a policy-induced disaster in the banking sector. That's due to central bank policies. And it's the central banks, they're reaping what they sowed. Now, the central banks actually are not surprised by this because they engineered this. They also like this very much. Why? Well, the central banks have decided a few years ago that they're going to compete with banks. This happened around, you know, sort of before the 2008 crisis. There were clear indications that central banks wanted to rip up the old agreement between the banks and the central bank, the old concordat, as Charles Goodhart calls it, which delineated the tasks of the central banks versus the banks. And of course, one important aspect of that was that banks, the central banks will, you know, they're regulators of the banks. They will not suddenly compete against banks because, you know, you're a regulator. That's totally conflicted and will lead to disaster. But that was the old story. That's been ripped up. Central banks are competing against banks or willing to compete against banks. They're preparing for this. They've been preparing for over a decade by issuing, by essentially opening current accounts for the public. They call this central bank digital currency just to make it, to hide really what's happening. But essentially they're saying everyone's going to have an account at the central bank, and we use digital technology so we can, you know, do it on your mobile phone or ideally on the microchip implant under your skin, that sort of thing, to make it trendier. But really they're saying we're going to compete against banks. Everyone's going to have a current account with us. And because we're competing against banks and we're the bank regulator, actually we might as well kill the banks. And so they've given banks a very hard time since 2008. And in Japan, of course, since the early 90s, which is why thousands of banks have already disappeared. Now, negative interest rates. We're being told again, that's the solution. America now is going to do it. And the UK, you know, recent government bond issuance, a negative yield and so on. So it's happening more and more. Isn't that good? Isn't that a good thing? Yes, if you want to kill the banking system entirely, and if you want deflation and no recovery, it's a great thing. But of course, it doesn't help the economy at all. As we know, we did this empirical study that I mentioned, look it up, Ecological Economics 2018. There is no empirical evidence that lower rates lead to stronger economic growth. And we looked at, in fact, in one study, it's the G4 biggest economies for half a century. Another study looked at 19 countries over half a century with higher frequency data and. So it's very clear that lowering rates does not help the economy. But it's a nice cover. It gives the impression, well, central banks, they're certainly doing something. And the other thing it does is it gives you an excuse to abolish the other competition, cash. And so because the logic has been, well, we need negative rates to help the economy. So this only works if we abolish cash, otherwise people move into cash. So let's abolish cash, and then we just, and of course, abolish banks. We have central bank digital currency. We have narrow banking, which means, and I agree with Mario, that's not really banking. We can't call these banks. So really, we're talking about the central bank plan to abolish cash, abolish banks, and further ruin the economy by having negative interest rates, which accelerates what they've been doing for the last decade and more, which is this transfer of resources from the many to the few, because of course we have this asset inflation increasing inequality. Now, I may be out of time. How am I doing? Can I just have a few sentences on the current situation? 2 minutes. Okay, sure. Great. Thank you very much. So what about the current situation? The current crisis. I mean, it is a disaster. And I agree with everyone who's commented on it, that it's a really shocking disaster. And thank you for Kristof for the figures you showed us. And we have to be reminded, it's just an incredible disaster. And this time it's completely 100% and it's visible, government inflicted, it's policy inflicted. And as you know, there's of course many medics and scientists who disagree with the lockdown entirely. We won't have time to go into this debate, but it was just one view to say that we need the lockdown. And that of course created the disaster, not the virus. So it was a government-imposed shutdown of the economy, record unemployment, 40 million people unemployed in the US, and millions in other countries. Particularly small firms are gonna go bust, entrepreneurs, and so on. And of course, SMEs account for between 2/3 and 80% of all employment. That's why this is not a surprise. So how have the authorities reacted? We've seen it, and Matheus did a good job in going through, well, the measures, particularly of 2008, and then to some extent also what they've been doing now. In fact, I have one graph that maybe I can try my system again, whether my computer can put this graph up, because that will illustrate it sort of, well, I think it's better said in words. Also, I'm out of time. So the big difference is between 2008 and now that in 2008, the banks shut down, bank credit creation, even in the US where they recovered fastest, for 1.5 years, there was no bank credit creation. So it took until the second half of 2010 for bank credit creation to recover in America, and that was the first country for that to happen. But it's not like that now. Bank credit creation is booming. Bank credit creation is expanding. They're creating a lot of money, and the central bank is creating money. So that's a very, very different story to 2008. And therefore, it looks to me like the idea this time around is to actually debauch the currencies to the extent that people will say we need a complete reset now with, we need central bank digital currency, and we need to link them, as Mark Carney said last summer in Jackson Hole, and we have the global currency because I mean, we need to see more data, of course. I'm only looking at the April data now, where we have a full month, but it's quite extraordinary. So the central bank, similar to 2008, but also the banking sector, which is a multiple in size of the banking system, is also massively expanding. We did not have a collapse in the dollar 2008, because it was only the central bank creating money, not the banks. They're much bigger. The banks were shrinking. So total credit creation actually went down. We did not have inflation 2009, 2010, or aftermath 2011 because bank credit creation had been down and was only recovering by 2011. But it's different now. So the problem really is going to be, if this continues and April is not just a fluke, which may still be possible, but if this trend continues, it's very clear that the Weimar scenario is the scenario that's being implemented, and likely in order to accelerate these plans that I already criticized since 2015, 2016, to abolish banks, abolish cash, and introduce negative interest rates and introduce central bank digital currency, which is a tool for totalitarian control, because everything you do will be monitored. Everything is through this tool. Where you are, what you're doing will be monitored through this. And of course, if you're criticizing the central bank, they can easily switch it off. Thank you very much.
Thank you, Richard. So we're going to go to some commentaries. I'm going to try to open it to a few people if they are interested. I'm wondering if Mario has any comments. I've unmuted you. Oh, I can't unmute you, Mario, so you have to do it yourself.
Yeah.
Perfect.
Okay.
Thank you, Mario.
Yes, thank you. Thank you, Richard. Very stimulating paper. I do have, all kinds of questions, but there's no way we could go through those. But I want to ask one, let's call it a big question here, an important one right now, which is why did you get started or insisted in framing all of your analysis? You started with a kind of quantity theory, and you emphasize it's a theory. I mean, it's a tradition that goes way back, and it starts from a certain mode or certain framework of causality, okay, that we're all familiar with, okay, and then you sort of put it into the quantity theory of credit. And in my brain, I'm in that causality. And as I said, that is terribly confusing, to say the least, personally. Okay. So I'm just saying that as a matter of fact, because I mean, there's a whole, you start with this velocity stuff. There's a whole tradition. As you know, Keynes was a quantity theorist, you could say, until his finance motive stuff. Before that, even in the general theory, he's still talking about how you modify the quantity theory, right? By means of, some sort of velocity, the liquidity preference and all that kind of stuff. That, what you were saying earlier was just expanding that to all objects of liquidity, and you could still be in that mode of the quantity theory. You see what I'm saying? So one is that question, which for me was somewhat perplexing. Secondly, you were talking about the banking sector facing a crunch. Now, it's true that there were a bunch of bank failures, I mean, in the US, but and in this country, actually, we didn't have any bank failures at all. In fact, they're doing very well even now, but we have a much more concentrated banking sector. And, but what's clear is, and I've looked at the data on this, it is true that if you go back over the last 40 years, the interest spread has narrowed. Now, is it because of competition? It could be, because in the case of Canada in particular, they opened it up to foreign banks in the late 70s and then 80s and so on. So, I mean, there are factors that one could think in terms of sort of industrialization issues, if you wish, about the nature of the banking sector. But what you find at the same time happening is that there's a massive increase, especially in the 1990s it starts, where you have all these other types of non-interest forms of income revenues to the banks that just exploded. So like now you'd say about at least half of the revenues of the banking sector, at least in this country, comes from these non-traditional form of fees and all kinds of stuff there, okay, which have nothing to do with the interest spread, Okay, so that to argue that that is the reason for the collapse, I mean, as I said, there's no collapse. If there was a collapse, it was because of their own freaking problems, like during the financial crisis. I mean, obviously in the US, we know that, but it's not because of narrowing interest spreads and the fact that now, and I agree with you that in the case of a central bank digital currencies, that could squeeze them more. But what is also true is that what they've been doing is gouging people like myself who still use banks for all kinds of stuff, tending to have to, you know, pay for all kinds of things, as an example. And these sorts of fees and so on have just increased, and because of the way they could now trace everything, they could charge you for anything practically. Okay, so I'm just saying here that I'm a bit uneasy. Now, I had a lot of other questions. Just one last thing I'll mention, because you referred to Japan about QE. I always thought you had a kind of, to me, what was a different definition of the distinction between credit easing and quantitative easing. I thought that credit easing were in the form of what we call sterilized purchases of assets. So in other words, you know, versus quantitative easing, which was unsterilized, essentially. That's the way I define them, but you seem to have a rather different way of, you know, defining that.
Thank you, Mario. Richard.
Yes, thank you very much. Very, very stimulating comments and questions. Thank you, Mario. Appreciate it. Maybe I'd start with the last one first, because it's very brief. I just used the definition that Bernanke himself used. It's online. If you look up his LSE speech in January, I think it's 2009, not 2010, January 2009, giving a speech at the LSE, Ben Bernanke, and there he explains it. And his explanation is very much in line with my original definition of QE of 1995, which is an expansion in credit. Now, he didn't say credit creation. That would be ideal, but central bankers are very cautious about this. And so I was just trying to get to his original definition. Your other point about the margins, and yes, you're absolutely right. Banks have diversified their revenues. In fact, they've been forced by regulators to diversify their revenues. Regulators have asked them constantly, try to get other revenues, because the regulators already were thinking we want to drive them out of the banking business because they were going to open their accounts, it seems, because otherwise it's very hard to understand why regulators have done this. I've myself been in a meeting of a bank meeting their regulators. They have regular meetings. So I've been present, and it's extraordinary. I mean, this is the ECB lowering interest rates, and the bankers, if you talk to the bankers, they tell you, look, they're driving us out of business. It's going on year after year. We can't go on forever. We have to look for another partner to merge. That's, by the way, why you don't see the headlines of these thousands of banks disappearing, because, of course, you know, banking is a fragile business. And of course, they try to then arrange, if they're in trouble, they try to arrange a merger with other banks and do this quietly. And this has happened. So they've disappeared because they've been forced into mergers. But it's true that they had diversified away from the revenues from bank lending, but they're still half or more than half for almost all banks in any country. It is still the bread and butter is the bank lending. And it's of course the most profitable business because the banks create the credit out of nothing in aggregate. So as long as they cooperate, then this works very well. But they've been hit by the central banks on this business and more or less been driven out of it. So, and the other point now was, okay, your first question was why quantity? Well, why did I start with velocity and discuss this? Well, my whole framework is based on this quantity theory of disaggregated credit. And it's useful for everything. It's the basis for the original quantitative easing, which is expansion in credit creation for GDP transactions. Because what the second equation, or one of the two equations, the real economy equation says is bank credit for GDP transactions will give you more GDP growth. And it's empirically, I've demonstrated this in various papers, that alone explains nominal GDP growth. Other variables drop out as not adding any information value. But of course, you have to disaggregate credit for the GDP credit. So it's the basis for the original QE, but also for an analysis of the impact of any central bank measure, because then you see if credit is used for asset transactions, and central bank money injections 2008 were in most countries were mainly for asset transactions, then you will get asset inflation, because the second formula explains asset markets. It's the key determining factor of asset prices is bank credit creation for asset purchases, includes of course property, the whole real estate bubble. So you see those. So it's important, I think, to show that background, and then we can have a comparison of 2008 versus 2020, where now we have both the asset credit creation rising and bank credit also for GDP transaction rising, and that's different. It's different because that then is more likely to lead to inflation. Before, the problem was deflation. And so that could be the biggest surprise, I think, because most people still think deflation is the problem. So that's why I felt this was needed. But maybe the other point that is relevant to all of these questions that you raised, Mario, is that fundamentally I see there's essentially two paths possible of how banking systems and financial systems can change. And what we're seeing worldwide is pressure by central banks to create very mono banking systems with centralization in the hands of only the central bank, of credit creation, the decision how much money is created and how it's allocated in the hands of one institution, usually the central bank. And the alternative is to have a decentralized system where we've got many, many banks. And ideally, I'm an advocate of not-for-profit local community banks. In fact, I'm creating them in the UK at Local First Community Interest Company. We're setting up the Hampshire Community Bank and other community banks we're working on a German model, which has been very successful. 80% of German banks are not-for-profit community banks, the savings banks, the cooperative banks. They're very decentralized and small, they're local, they're accountable locally, and they create credit mostly for productive purposes, which means in the quantity theory of disaggregated credit, you'll get non-inflationary growth and prosperity and job creation, because small firms are the main job creator. That's what we need to aim for. Unfortunately, the central banks in many countries seem to have favored the system that we had before in the Soviet Union, where there's only one bank. This system is a failure. Now, when Deng Xiaoping came to power in China in 1978, he made an important decision, namely, he must have analyzed the Soviet Union because China was very similar to the Soviet model. It's essentially the Soviet model. And he decided, no, we're going to go away from the centralization, and we're going to create thousands of local community banks. And that's what he did. And that's what followed was 40 years of double-digit economic growth. It's because of the creation of thousands and thousands of local banks. America had much higher growth when it had more than 10,000 banks. We only have 5,000 left now. So we need this decentralization. That's also more resilient in crises and is empirically more successful. But why this infatuation suddenly in all these Western countries with centralization, central bank digital currency, killing banks, and having this totalitarian control imposed on us? And of course, this is being accelerated by this so-called COVID crisis, because funny enough, in these COVID laws that were passed in record time in March, in America, 1,000 pages, in the UK, 350 pages. So they did not write this in 3 weeks. No, these were prepared well in advance. You need years for that. And in America, they originally in the draft had the digital dollar in there. And the central banks have all come out in March saying, well, we now need to accelerate central bank digital currency. So you see the agenda that's being pushed out. But it's one that's is highly flawed and was discredited by the collapse of the Soviet Union. Why do we want to copy the Soviet Union?
Okay, thank you. Matheus Grasselli might have something to say following your presentation. Matheus? Make it brief.
I'll make a brief. I mean, what can I say? I'm not going to shed a tear for banks. I think you know they. From historical times and throughout the the entire century and before, they have maintained this privileged place in the economy precisely because of doing both the lending and the payment system function, which is of course at the core of endogenous money, and then they create money, and that money doesn't need to be used entirely for productive purposes. It can be used for speculation. But I don't accept this as a fundamental law that has to be like that. You know, all of this are creatures of societal conventions, and it doesn't need to be like that. So the proposal of narrow banking is to precisely remove this extraordinary privilege, which Gerald Epstein calls the banker's club here in both senses. It's a small collection of people, but it's also the club with which they bang the rest of the economy on, that they are fragile and that they need special treatment, and that they should be allowed to operate with ridiculously low levels of equity, which no other enterprise operates. And that to me is the most interventionist and distortionist policy that allows precisely the expansion of credit for things that have nothing to do with economic growth. So the narrow banking idea is that there'll be different facilities, and these facilities don't need to be centralized. So the idea that you're talking about is small community banks, they're precisely compatible with that. They would be situations where the only difference is that on the liability side of these facilities, you are not going to have demand deposits, and you're not going to have demand deposits that are guaranteed by the government. So if you want to remove the government intervention, remove the guarantee to the demand deposits, and have this to be time deposits in one situation where, you know, this is the local community lending to the local businesses so that they have credit to expand. Or if you don't want to make a time deposit, make it equity based, and there are many other already institutions that do that. So just make this the way of operating. This doesn't have to be centralized. Of course it could be centralized, but it doesn't have to be by design centralized. So I have two more points. One is on central bank digital currencies, the other is on interest rate. Let me start with the interest rate. So sure, interest rates don't lead growth, but as you said, they are correlated, and the idea is that when growth is plummeting, it's high interest rates at the time of low growth exacerbates the problem because it creates more financial constraints, it creates more fragility in the financial system. So if you really don't think that interest rates make any difference, go ahead and raise interest rates. So let's see, in the middle of a depression right now, put interest rates at 5% if they don't make any difference. And I don't think anybody would say, let's raise interest rates. So if raising interest rates is seen as damaging, then maybe it's because lowering interest rates goes in the other direction. Might not lead growth, but alleviates the problems that would be associated with raising the interest rate. So my challenge to that is, if interest rates don't matter, go ahead and raise and see what happens. And the final point is on central bank digital currencies. The proposal is not that they run banks out of business. In fact, in the narrow banking idea, it's very explicit that banks are still doing the payment system, but that's all that these narrow banks, it's all that they do. They have reserves and they earn interest on reserves, and they have deposits and they pay less interest on deposits, and they make their money out of the spread. They are just like a public utility. And in fact, there was a bank that tried to do that in New York. They applied for a license. They were called DNB, the narrow bank, and this was denied. And it was denied because of the lobby of the other banks, because the other banks were afraid of this model, that people would actually prefer to have their money in a bank that doesn't have tiny amounts of equity and is subject to collapses and have to be rescued by the central banks all the time. So it's not to run banks out of business. There could be a very significant role for banks in a payment system that is separate from central bank digital currencies, because nobody's saying that you have to have all your deposits in central bank digital currencies. It's another option. So nobody's saying keep all your money there. And it's a facility that can be quick transfers. Instead of going through the banking system, you make a quick transfer when needed to households or to small enterprises. And what they can do ensure that they can immediately take it out. You don't want the central bank to do what you know what you're doing with your account. Withdraw the instant you receive it. Withdraw and put in a bank and do everything else that you are normally using with the bank. So certainly not a plan for world dominance and for turning us into the Soviet Union.
Thank you very much. If I may just respond.
Yes, but briefly, because
Yep.
we're getting towards the
Yep.
end.
Okay, I'll try to be very brief. So you say that the banks have had a privilege, a place, this extraordinary privilege of money creation. So let's abolish that. Well, since when was the call to abolish bank credit creation raised? Only after I published in various documentations, and also post-Keynesians have published that banks create money, because this is the plan B of the financial oligarchy. Because what they really want to avoid is that this privilege of money creation goes back to those to who it belongs. It belongs to the people, and the people should get it back. And the only way to do that is by having many local, not-for-profit community banks in the hands of the people. Then the privilege is where it belongs. But the financial oligarchy, of course, doesn't like that. That's the last thing they want. So they're saying, oh no, we've just discovered, and the central bank's now coming out, we just discovered banks create money. Oh, who would have thought that? Well, we better abolish that immediately. I mean, you got to laugh. I mean, it's a trick. So this extraordinary privilege needs to be returned to who it belongs, and that is the people, and that can only be done when we have small organizations. What we've learned from the 20th century is that the overarching trend, which has been disastrous, has been to concentrate ever more power in the hands of ever fewer people. That's been the disastrous trend of the 20th century. And we're now at risk of accelerating that tremendously by concentrating the power of money creation and allocation in the hands of a tiny committee of those people. If we take it away from the banks, who will decide this? And that is likely to be an even bigger disaster. And therefore, because as we know, this power corrupts, and absolute power, as this would grant, absolutely corrupts. So we need to do the opposite. We need to decentralize, and we can do this, and this is proven to be successful by having many small local not-for-profit banks. Because essentially you need to distinguish between the big bad banks, and they've been doing bad stuff, and the good not-for-profit local banks. They have not done any bad stuff. In Germany, 2008, for example, there wasn't even a recession when the 2008 crisis hit many other countries. Why? Because the local community banks did not do any of the speculative stuff. They had no non-performing assets. They didn't need any bailouts. In fact, in 200 years, no government money, no bailouts ever needed, and no depositor lost money. And they're 80% of all banks in Germany. So these are the banks that we need in other countries. But usually the lobby by the big banks and the central banks, remember the central banks were created by the big banks. They've always worked against these people's banks. We need more people's banks. That should be the place where this privilege of money creation is located. Now, just briefly on the other 2 points, you say, if interest rates are not so important, let's raise them. Well, that's my recommendation. We need to raise them. In fact, the central bank should come out now and say, we've actually done some empirical work. Negative interest rates are nonsense. Why? Because it's just a tax on the banks. Because, they're holding all these high-powered money on their, with us at the central bank. They're not lending it out. That's the rationale for negative rates. But that's nonsense, because banks cannot lend out central bank reserves. What's happening? I thought you guys understand credit creation. Then you should know that the bank's reserves at the central bank cannot be lent out. This is money created by the central bank, and it cannot be lent out. It cannot circulate in the economy. Therefore, it's nonsense to impose negative rates on that to drive this money out into bank loans. That's complete nonsense. Anyway, so the central banks could say, we've actually wisened up. We'd studied the facts. Negative rates are nonsense. So actually, we're not going to do that. And we're going to raise rates. Now, they just need to raise them a little bit. The bond market is going to do the rest, because you get a huge spike in the bond market. Interest rates shooting up, and that gives the steep yield curve a positive yield curve, and that's what the banks need. and then the banks can profitably lend again, and the banking sector can be rescued. So yes, we should do it, because when banks lend, you get more quantity of credit creation. That's the other reason why I needed to mention it, because most people still think it's all about interest rates. No, it's the quantity of purchasing power, because we're not in this textbook world of general equilibrium. I think people should have realized by now, and this crisis shows us, this is disequilibrium everywhere. And in disequilibrium, which is always the case anywhere, it's the quantities that dominate, not prices. And the quantity of credit creation is the key quantity. And therefore, that's why we can raise the price of money a little bit, as long as we have more quantity of purchasing power in the hands of SMEs and money supply expanding as a result, we get a recovery. And credit creation, the final point is just one sentence, sorry for running over. The final point, we're not really abolishing banks in this proposal with central bank digital currency. They can continue in some way. Well, if you don't have the power to create credit, you're not a bank. The definition of a bank is, and I think Mario will agree with me, is the power to create credit. Otherwise, you're a non-bank. So the proposal, let's face it, by those who argue for central bank digital currency and for having full reserve banks, is actually to abolish banks, because they would be turned into non-banks. And there's empirically no evidence that this helps the economy, because what we're likely to get is no more economic growth. Because we need the decentralized decisions to create money productively, give it to local small firms for productive investment, then we get non-inflationary stable growth. But if you take away this privilege, there will be no more growth. We'll get deflation.
Okay. I'm going to stop you there. Thank you very much. I think this brings to an end this webinar. Again, I apologize for the bombing. Stories that we'll be able to tell at conferences. Do you remember when? So thank you very much. I will be rendering this video and putting it on YouTube. I'm going to give the final word to my co-host today, Guillaume Vellet. Please, Guillaume, unmute yourself. Thank you.
Is it okay? Can you hear me?
Yes, yes.
Yes, thank you very much to all of you. Thank you to the speakers. Thank you also to Mario for his great comments. And of course, thank you, LP, for organizing this event. And also thank you for the good electronic music you put at the beginning of the presentations. So, I think it's, of course, difficult to learn and to know exactly what central banks have learned with the crisis. I think what they have learned first is that they have learned to react very fast. Also, of course, as Richard mentioned, they have reacted at different paces, but if we look at the ECB, this is a very big difference with the previous crisis. Secondly, they have been given new missions. We have dealt here today with financial supervision, macroprudential measures, and I think this is required if we consider the rise in volatility of international capital flight. With my PhD student, Bruno Tomio, who is listening to us, we have been working for 2 years on carry trade operations. And I think this is a very big danger for central banks in the future. And I think that there will be a rise in the crises of that kind because of climate change, for instance, will lead to a rise in capital movements all over the world. And I really appreciated Kristof's presentation because he talked about the importance of the financial channel for central banks, and I think is right. He's right. But thirdly, if we give new missions to central banks or new tools, I think it's important to question their power, because new power maybe will be given to a central bank. And as Hassan mentioned, I think it's important to also think about the relationship with government and the issue of their independence, for instance. Independence has really become a misnomer in my view, and we should maybe think about new embeddedness for central banks. To conclude, I think central banks have entered maybe uncharted territories for two main reasons. Maybe first because there are also differences between the two crises. And I think we are living in a world of uncertainty, as Mario said. So this is very difficult for them to know what is going on. And I think we really need some cooperation between central banks. I think we didn't stress enough the need for international cooperation between them. And as I said, this will be needed if we consider that new crises will come, especially, I repeat, regarding the issue of climate change. And finally, my last point will be that to learn means to be ready to learn and to be open-minded. So it's also a matter of culture in central banking. If we give a new power to central banks, if we give new missions to central banks, we also need maybe more diversity in central banks. And regarding this issue, maybe gender diversity is one of the solutions, and this will be the topic next week. Thank you very much.
Thank you very much. I do want to end on one note before saying goodbye, that a lot of these topics, Guillaume and I, with Silvio Capes from Brazil, we're editing a series of 10 books on central banking and monetary policy and dealing with issues of gender and financial fragility and social responsibility and income distribution, and a lot of the issues that we were discussing during this seminar. Thank you very much, everyone. Again, sorry about the bombing, and I'll see you all very soon. Thank you to all our 3 guests and our commentators. Thank you. And like our old friend says, vive la révolution.
Thank you for organizing this. This is fantastic. Thank you.
Thank you very much, everyone. Bye-bye. See you soon.
Thank you. Bye-bye.
Thank you. Bye.
Bye.